Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 24th of February 2015. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are viewing this video anywhere other than on our Hurst Trading Room podcast channel, then please make sure that you subscribe to that so that you are notified of any new videos that I make. You can subscribe either on iTunes or on YouTube. Let's take a look at the markets, and we'll start, as we have done for the past several videos, with the S&P 500 and a discussion of the US stock markets, which of course have a lot in common with stock markets around the world. So many of my comments about the US markets also apply to the European stock markets. In last week's video, I discussed the possibility that a 20-week cycle trough had formed in the beginning of February, about 3 weeks ago. That's this very prominent trough over here. So take a look at that video if you haven't seen it. It is very possible, in my opinion, that that was the 20-week cycle trough that we were expecting. You can see that that rather skew arrow that I've drawn does come down into the range of the possible time that the 20-week cycle could have occurred, according to this analysis, which is, of course, that circle and line, what we call the circle and whiskers. That represents the expected time for the 20-week cycle trough. And so right at the beginning of the expected time for the 20-week cycle trough, a trough did form, and as I discussed last week, I think it's very possible, even probable, that that is a trough of the 20-week cycle. That, of course, presented us with a problem. If I clear this and highlight the FLD, the problem was, what should we do about the next interaction with the FLD? Because, of course, we trade interactions between price and the FLD. And I mentioned in last week's video that if this trough at the beginning of February was a trough of the 20-week cycle, then the next interaction between price and the FLD would be a category B interaction, because here was the A back in the first week of February, and I can't seem to draw the crossbar of the A, there we go, and then we would expect B, which would be price coming down to the FLD, finding support there and bouncing back up again in a C category interaction. So we would expect a B and then, of course, a C. If, however, the trough at the beginning of February was not a 20-week cycle trough, but indeed only a trough of 20-day magnitude, as is presented in this analysis that we're looking at here, then of course, we would expect price to drop down through the FLD to come down into this 20-week cycle trough. The nest of lows is still shown at the foot of the chart. It is leaning over to the left, as you can see. And that means that that trough is now fairly overdue. When a nest of lows leans over to the left like that at the foot of the chart, it means that the trough is overdue. Or at least the trough might have occurred, but it hasn't been confirmed yet. And so if it has not yet occurred, then it is overdue. And so, of course, we were expecting price to cross down below the FLD in a category F interaction. So I left you at the end of last week's video with that situation. I mentioned that I would not be interested in entering into a short trade because I did not think it would be an F category interaction. I was expecting a B category interaction because, in my opinion, the odds were on that this was a trough of the 20-week cycle. As a matter of interest, of course, it proved to be something we didn't really need to worry about, and that's because price didn't quite touch the FLD. But let's just zoom in there and see what price did do, because it's fairly instructive. And here you can see price bounced out of this trough here, which is the trough that I believe was probably a 20-week cycle trough, and it crossed the FLD over here. That's our category A interaction. And then last week, you can see on Friday, price came down towards the FLD. It came very close to it. I'm going to circle that little area over there. You can see here's the FLD. I'll draw over it to make it a little bit stronger in the video. And price came down very close to that FLD, didn't quite touch it, and then, of course, bounced up again on Friday. And the S&P 500 went up to new highs on Friday. Now, that, in my opinion, is an absolutely classic B category interaction. Right, what we expect in a B category interaction is for price to come down to the FLD, possibly touch it, perhaps track along the FLD for a few days, but generally bounce back up above the FLD. And so, in my opinion, that strengthens the chances that the trough at the beginning of February was a trough of the 20-week cycle. It also makes our next trading decision much simpler, because now the analysis that we are seeing on this chart, and let me just zoom out again and show you this analysis a little more clearly. The analysis that we are seeing on this chart is saying that we are still expecting a 20-week cycle trough to occur. As I've mentioned, it's probably overdue now. And therefore the next interaction between price and the FLD will be the F category interaction, which recommends a short trade or suggests a short trade. And so we would expect to see price come down through the FLD, probably fall fairly hard in order to achieve this 20-week cycle trough. Now, that is not impossible, as much as I believe the chances are in favor of the fact that the 20-week cycle trough formed at the beginning of February. It is not impossible that this analysis that we're looking at here is indeed still the correct analysis, and so therefore the F category short trade would be the next trade, and it would be a trade I would be very interested in taking, because if this analysis is correct, then price must come down fairly hard to form that 20-week cycle trough. What if this analysis is not correct? Well, fortunately, we still don't have to be stuck with analysis paralysis, where we can't make a trading decision because of our analysis uncertainty. Here is the analysis that shows the 20-week cycle trough at the beginning of February. Notice, as a matter of interest, the number of troughs that I've had to pin, which means I've influenced this analysis because I believe this is what has happened. And Sentient Trader is a tool that you can use to explore your analysis ideas, and of course I've done that here. And I've told Sentient Trader by pinning those troughs in various positions to position the troughs there. Sentient Trader will make sure it doesn't break any of the rules or do anything impossible, which is why you cannot always pin a trough somewhere. But as you can see, it is showing us this analysis, and so it is therefore a possible or a valid analysis. And so here is price bouncing out of that 20-week cycle trough, which is phased at the foot of the chart. And there's our A category interaction. I'm having a bit of trouble with this pen. And then we would expect the B category interaction as price comes down to the 20-day cycle trough, which you can see was expected last week according to this analysis. There's the nest of lows for the 20-day cycle trough. So that's the B category interaction. We are now in a C category interaction according to this analysis, and the next interaction would be a D category interaction. What does that imply? That means that we should be looking at a short trade to catch the move down into the 40-day cycle trough. So we have a situation that is not unusual when using Hurst Cycles to analyze the markets. That is that we have two trading opportunities that are in agreement with each other, even though they originate from slightly different analyses. In other words, no matter which analysis is playing out, a short trading opportunity is our next trading opportunity. Of course, if this analysis that I'm showing you here is the correct analysis, then we would not expect that D category short trade to be a very good profitable one. It should be profitable, don't get me wrong. We would expect to see price come down, cross the FLD and go an equal distance below the FLD as it was above it before it started the move down, and that should be a good profitable trading opportunity. But then price would bounce out of the 40-day cycle trough, and we need to be quick about getting out of that trade. So certainly I would enter into the trade, but I would stay on my toes. I would watch that trade very carefully. And as soon as it showed any signs that price was already bouncing out of a 40-day cycle trough, which, as you can see, as a matter of interest, is expected pretty much towards the end of next week. So as soon as I see it bouncing out of that 40-day cycle trough, and remember, with a bullish underlying trend, which we definitely have here, we can expect troughs to occur early. So you should be standing by for that trough to occur early. As soon as there's a sign that that trough has formed, even if your T2 target has not been reached yet, I would certainly look at setting very tight stops to get out of that trade and protect as much profit as I could. If, on the other hand, the other analysis is correct and price is coming down to a 20-week cycle trough, and let me show you that chart again just to make the point absolutely clear, then of course this would be an F category interaction that should prove to be very profitable, because we are expecting price to come all the way down into a 20-week cycle trough. Now, that 20-week cycle trough does not need to occur at a lower level than the trough at the beginning of February, but we would certainly expect it to approach that level. So that would be a much more profitable short trade. But either way, no matter which analysis is playing out, a short trade is definitely on the cards next, and it should be a profitable short trade. Depending which analysis turns out to be the true one will depend how long that or how far that trade will run. Let's take a look at the euro to US dollar. Now, I spoke about the euro to US dollar in last week's video as well, and I'd like to add a little bit more detail about that. And here we're looking at a chart that I showed you last week. And of course, I was speaking about the fact that we are expecting a trough of a very long cycle to form in the euro at the moment. We have been expecting it for some time, and you can see this analysis has in fact updated itself, and it has positioned that very long trough over there in the month of January, towards the end of January. I think it was the last week of January, that very long cycle trough of, according to this analysis, 54 months. It's possibly even a trough of the 9-year cycle that we have been expecting. Now, when you're expecting a very long cycle trough like that, 54 months or 9 years even, I recommended last week that we should be very careful about jumping into those long trades. In fact, when I first spoke about the euro many weeks ago, I mentioned that trying to catch the bounce out of a very long cycle trough can be a little bit like standing in front of a train and expecting it to stop. When a market is heading down into a very long cycle trough, you have to be very careful about making premature decisions about it turning up. Once it has turned up, of course, we would expect to have the opportunity to make many profitable long trades. So there's no reason to rush into it. But I would like to spend a little more time speaking about the euro to US dollar, because it presents some interesting analysis puzzles. And the first one is this. According to the nominal model that we use, and there's been a lot of discussion about nominal models on the Hurst Cycles website. It's a fascinating discussion, a very important part of Hurst analysis. Hurst defined a nominal model which he applied across all markets. I found that nominal model works very well across many markets. I built into Sentient Trader the ability to adjust a nominal model and to create your own nominal model. And of course, the reason I did that is because I found it was sometimes necessary, and that you could often achieve a better analysis by creating your own nominal model. And so that's why Sentient Trader is able to do that. But let's take a look at what's happening here. First of all, we have a big trough, of course, in November of 2005, and then we have a very big trough in June of 2010, and we don't have a trough yet, but potentially we're forming another trough round about now. So those are the troughs of the 54-month cycle, and if I clear that and I turn on my bar measuring tool, you can see that first cycle from November 2005 until June 2010 is 54.6 months. So pretty accurate in terms of 54.8 months, pretty accurate in terms of being a 54-month cycle. And the amount of time that has elapsed since the June 2010 trough at the moment is, or let me measure it up until the end of January to where that trough potentially formed. That was 55.4 months. So again, very close to the 54-month cycle that we expect in the markets. But now here is where things break down slightly in terms of this analysis, and that is the next cycle down, which is the 18-month cycle. Now, according to Hurst's nominal model, we have a 54-month cycle, and then the next shorter cycle is an 18-month cycle. And of course, for every 54-month cycle, there are 3 18-month cycles. So now this is where the analysis of the euro begins to create a few question marks. Here you can see the yellow lines indicating the 18-month cycles. Let me just indicate on the chart where these 18-month cycles have been positioned. They've all been positioned at fairly prominent troughs, as you can see. But that cycle, that first 54-month cycle, does not look like an iteration of 3 shorter cycles. It looks like the normal combination of 2 cycles to form the standard M shape that we see in markets all the time. There's the M shape, and so it looks as if though that 54-month cycle broke down into 2 shorter cycles rather than 3 shorter cycles. Now if we look at the next 54-month cycle, you'll see that in fact exactly the same thing happened. Here is, according to this analysis, here is the potential position for the first 18-month cycle. That looks like a good 18-month cycle. But here is the next 18-month cycle, and you know, we've got something very odd happening right about there, which I'll speak about in a moment. And then here is the third 18-month cycle. Again, in that second 54-month cycle from June of 2010 until January of 2015, we don't see what looks like 3 cycles, but in fact we see 2 cycles. There you can see a very clear, very clear M shape. Now the M shape is simply the result of combining cycles with a harmonic ratio of 2 to 1. Here we should have a harmonic ratio of 3 to 1. So it doesn't look quite right. And what about this rather awkward situation over here, which is the second 18-month cycle of the most recent 54-month cycle? Let me draw the M shape, of course, that we expect to see. And there it is. That's the M shape for that 18-month cycle. Do you notice the middle part of the M is dropped down below the start of the M and the end of the M? That's what I call an inverted cycle shape, because we don't normally expect that. Normally the central trough that forms the center of the M is at a level that is of course higher than the start and the end of the M shape. So we have an inverted cycle shape. Now that's not impossible. This whole thing of cycle shapes is purely my way of approaching Hurst cycles. It's not laid down in law. There's nothing that says you can't have an inverted cycle shape. You can. But in my experience, the more inverted cycle shapes that you see in an analysis, the less good that analysis is, in my opinion. So if you have more inverted cycle shapes, particularly when they are long cycle shapes, then I think they raise many question marks. And so this analysis raises a few questions. It has some puzzles that I don't think are very easily resolved. Let's take a look at a slight variation on this analysis, which instead of placing the 18-month cycle troughs here at the beginning of 2012 and then over here in the middle of 2013, instead places the 18-month cycle trough at the more obvious position, which is in about the middle of 2012. So here is that analysis, and as you can see from this yellow semicircle, we have one very long 18-month cycle, which is this one over here, followed by 2 fairly short 18-month cycles. Now that's not impossible by any means, but it's not really an ideal solution in my opinion. So I thought I would take a look at what would happen if we experimented with the nominal model. Now, as I mentioned, there's been a lot of discussion about nominal models recently on Hurst cycles because it is a very important topic. So let me show you what happens if you apply a different nominal model to the euro-US dollar. Here is the analysis where I have applied a nominal model that does not have a 3 to 1 harmonic ratio between the 54-month cycle and the 18-month cycle. It has a 2 to 1 harmonic ratio. In other words, in every 54-month cycle, it doesn't expect 3 cycles of 18 months, but it expects 2 cycles of an average length of about 27 months. Now, this analysis, as you can see, is very similar to the other analyses we've been looking at, which highlights another important point in my opinion, which is that the nominal model, while it is important, often perhaps refines an analysis, makes it look slightly better, solves some of the riddles, some of the problems with an analysis, but it doesn't completely revolutionize the analysis, and it often doesn't even mean that you're making different trading decisions, as I'm going to point out in a moment. So I'm using a radically different nominal model here. Well, I still have a 54-month cycle, but I don't have an 18-month cycle. I do have a 27-month cycle. Do you notice how the most recent 54 months have broken down into a much more comfortable 2 27-month cycles? There we go, like that. So that analysis, certainly in terms of just looking at it at the scale, looks better. It works a lot better, and we don't have any of those problems with inverted cycle shapes, which, as I've mentioned, doesn't totally invalidate an analysis, but it certainly raises some question marks. So let me get to the point. The point is that the analysis for the euro to US dollar presents some interesting questions. It's a bit of a puzzle, and particularly at the 18-month level and the relationship between the 18-month cycle and the 54-month cycle. How you want to resolve those puzzles is entirely up to you, and that's really where the art of analysis comes into all of this. But one way of resolving it is to apply a different nominal model. But let's take a look at what that means about our trading. Now, according to this nominal model, you can see that the very long 54-month cycle trough has actually been phased as having occurred in January of 2015. So let's zoom in and see what that looks like. Let me get rid of those semicircles. There we go. Okay, so here we have the trough, which, as you can see, has already been phased as the 54-month cycle in the last week of January. I wouldn't take that too seriously. It is possible that, in fact, that big pile of diamonds should be placed over this way a little bit. I mentioned several weeks ago that when price is bouncing out of a very long, such as a 54-month cycle trough, I will always watch to see what shape the first 40-day cycle makes before I want to get into that market. So what shape has it made? And I discussed this last week. So far, it has not been a very bullish shape. So far, we have probably only seen the first 20-day cycle form. I'll speak about that in a moment. But here's the 20-day cycle nest of lows, which was expected pretty much today or over the weekend, and perhaps on Friday. And so that 20-day cycle trough might have formed or might be about to form in the next few days, after which we would expect price to bounce back up again and then to come down into the 40-day cycle trough, which is expected now in about the 3rd week of March. So when I say that I want to watch the shape of the 40-day cycle, of course, I'm expecting that 40-day cycle to be bullish. So far, it's not looking very bullish. It's not too late. Of course, it might still become bullish, and we need to stay on our toes to watch for that development in case it does occur. But the first 20-day cycle was certainly fairly bullish. Okay, it ended higher than it started, but it had a fairly early peak. All right, you can see it had an early peak, which is a fairly bearish sign. When a cycle has an early peak, that's bearish. It was bullish because it ended higher than it started, and I'm assuming that 20-day cycle formed, 20-day cycle trough formed perhaps on Friday last week. I'm assuming it is forming around about this level. So we have a mixed 20-day cycle shape, which is not very encouraging, because if it's bouncing out of a very long cycle trough, we would expect it to be more bullish. But cycles, or the markets, are interesting things, and they don't always, we don't always get an extremely perfectly bullish cycle immediately following a very long cycle trough. So I'm watching this shape carefully. What would I do in terms of trading it? Well, according to this analysis, you can see that we have a 20-day cycle trough forming around about now. Let me just plot the FLD that we trade and zoom in just a little bit. There we go. Okay, so there's the 20-day FLD. So according to this analysis, of course, this would have been the A category interaction over here. It was a very disappointing A category interaction, as you can see, because a price sort of crossed above the FLD on one day and then immediately dropped down again. It didn't get anywhere near its expected target. Now, its expected target, just using the grid lines as a reference, would have been, somewhere up here, 117. That would have been the target of the A category trade. So that's really not a very encouraging sign. Price then came back down to the FLD, and as you can see has been tracking along it every day since then, except for this day over here, Friday of the second week of February. Price managed to actually sort of stay clear of the FLD, but since then it has been tracking along that FLD every single day, every single bar, and that is of course what we expect around about the formation of a B category interaction. So yes, it is possible that this is a B category interaction that is forming now. What's going to happen next? Well, we're going to get the C category interaction as price pulls up to the second peak of the M shape. We're expecting the M shape, and then it'll come down to the 40-day cycle trough. Now, usually, of course, I will wait until the formation of the 40-day cycle trough before making a decision about entering into this. I want to see that 40-day cycle shape, but there is a trading opportunity that is presenting itself to us already, and that is to enter into the long C category trade. I certainly wouldn't do it at the level of the 10-day FLD. Where's that 10-day FLD? There it is. I certainly wouldn't enter into the C category trade at the level of the 10-day FLD. Because it's just right in here, and of course this market might still fail and drop down again, in which case we would expect it to form the long cycle trough possibly towards the end of March. So then we're going to be going through this whole process again. You're probably going to get bored of me saying the same things about it, but if it drops down, then of course we have to wait a little bit longer. So I'm not anxious to get in here, but you'll notice that there has been a bit of a level here. I think it's at about 114,500 or something like that. The levels of last week's high. I would certainly wait for price to get up above those levels. If I was anxious to catch a short-term, and it might be a very quick short-term C category long trade, then of course price will come down into the 40-day cycle trough, which, as I've mentioned, is expected in the third week of March. And once we have a complete 40-day cycle, that would be a great time to look at that 40-day cycle and say, okay, how bullish was it? If it was a bullish cycle, then I would look at getting into some long trades in the euro. Of course, if you're anxious to get in right now, then maybe look at entering at the level of last week's highs. But of course, this is using my unusual nominal model, which has a 27-month cycle instead of an 18-month cycle, which might sound to you like a really big difference, but in fact, it isn't a very big difference. Let me go back to the chart that we've been looking at and speaking about for some time. This is the one that has the question marks surrounding the position of the 18-month cycle troughs and a potentially inverted 18-month cycle. Let me just zoom in and let's take a look at a consideration of exactly the same thing. What sort of a trade are we looking at making right now? Well, there's that FLD. Using this analysis, do you notice something? It's in exactly the same place. Okay, and here again, the 20-day cycle is expected to be forming a trough roundabout now. And so we have exactly the same situation. We had a very disappointing A category interaction back in the beginning of February, and ever since then price has been tracking along the FLD. As you can see, that might be the B category interaction. It's looking very much like a typical B category interaction, I must say. So don't let that enhance or increase your bearishness, the fact that it's tracking along the FLD. It is simply doing what it usually does and is expected to do at a B category interaction. That doesn't make it any more bearish. It might be that the bull is just taking a little bit longer to come out in this market because of all the politics surrounding the euro at the moment. There's something interesting to notice, and that is that the average wavelength, the recent average wavelength of the 20-day cycle at the right of the chart can be seen as 29 days. Why is that 20-day cycle so long? The reason is probably because the recent wavelengths, or the recent examples of the 20-day cycle, have all had late troughs. Why? Because the underlying trend has been down, clearly. Okay, the euro has been heading downhill really fast. There's been a very big underlying trend pushing downwards, a negative underlying trend. A negative underlying trend results in troughs occurring late, which means that cycles tend to stretch as they approach the trough, the very big cycle trough. So it's not unusual to see very long cycle recent wavelengths round about the time that we're expecting the market to bounce up. And as you can see, the 20-day cycle is very long at 29 days. The 40-day cycle is very long at 56 days. The 80-day cycle is very long at 89 days. Even the 20-week cycle is long at 20 weeks. It's usually about 17.9 weeks. So all those cycles have stretched longer, which is not unusual because we've had such a negative underlying trend. So again, we have the same opportunity here. We might want to catch a C category long trade if you're feeling bullish about the euro and you're feeling aggressive in terms of your trading. You could possibly get in there for a quick C category long trade, or else of course wait for the 40-day cycle trough to form, as it most certainly will. You can see it's expected slightly earlier according to this analysis, perhaps late in the second week of March, or sometime in the third week of March, and at that point reassess the situation and decide whether you are ready to go long the euro, or whether in fact the markets are continuing downwards and that negative bearish underlying trend is still going strong, and the 54-month cycle trough still lies ahead of us. Thank you very much for joining me in the Hurst Trading Room this week. I wish you, as always, profitable trading and look forward to seeing you next time.